Hello, and welcome to this video module on accretion dilution analysis. Accretion dilution analysis is an additional valuation technique often employed by strategic buyers in an M&A process. It's based on the premise that publicly traded acquirers will avoid deals that reduce their earnings per share or are dilutive to EPS. Buyers are attracted to deals that increase EPS or are accretive. There's a few key factors that impact accretion and dilution. These are the purchase price, the cost of financing, target company's earnings, and most importantly, in this case, the synergies, basically savings that can be instituted as a result of an acquisition. This is something that strategic acquirers have an advantage of over financial buyers. Two companies that strategically make sense to be put together may be able to reduce back office, headquarters, redundant employees, redundant locations. They may be able to save on computer systems, banking, all sorts of fees that, that strategic companies have to pay. Bankers can use an accretion dilution analysis as a valuation metric, similar to the way an LBO analysis was used for financial buyers in previous modules that we looked at. The analysis allows bankers basically to back into an implied valuation based on certain key assumptions. Let's take a look at the basic math, and we're going to go through some examples on the next slide, but what we need to do is look at a pre-deal earnings per share, so basically a standalone acquirer's net income and its shares outstanding. We're then going to calculate the post-deal shares outstanding. Now that's a factor of a few things. A factor of the purchase price, the portion of the purchase price paid with equity, or basically new shares, and the price per share of the acquirer. We're next going to calculate net income required to keep EPS constant. Basically take the original earnings per share multiplied by the new share count. We're then going to back into EBITDA by multiplying by 1 minus the tax rate. We'll add back incremental interest expense from the deal. So that's a function of purchase price multiplied by the portion of the purchase price paid for in debt multiplied by the interest rate. And after we have all that, we can back out purchaser EBIT, target EBIT, and we'll find the synergy numbers. Let's take a look at some examples on the next slide. So here you have some numbers based on our fictional Makeup Co. And you can see it's being acquired by Shampoo Co. So let's just follow down one column. We have a purchase price of $1.5 billion being paid for 30% debt, 70% equity. The cost of debt is going to be 8.5%. So Shampoo Co. has 100 million shares outstanding. Its shares trade at $23 a share and has a tax rate of 35%. So we could see we have Shampoo Co.'s EBIT. We're going to add Makeup Co.'s EBIT and some synergies. But what I want to focus on is what we said is step one, the pre-deal earnings per share. So we have Shampoo Co. EBIT of 200. It has no interest and it has taxes of 35%. So we know that Shampoo Co. had net income of 130 million, which we could see down here, and had 100 million shares out. So 130 divided by 100 is $1.30 EPS. So that's our goal. We know that whatever happens after the deal, we want to have at least $1.30 of EPS. So let's go to step two, the post-deal share count. So we know we have a $1.5 billion deal where we're paying in 70% is equity. So 1.5 times 70% is $1.05 billion. Divide that by 23 and we get 45.7 million new shares that need to be issued. So we now have, adding that to our pre-deal shares, we have a combined company share count. Well, we can in step three, we know net income needed to keep earnings per share the same is our new share count times our old EPS. So we know we need a combined net income of 189.6. If we then back out our taxes, so divide by 1 minus the tax rate, we get a combined EBITDA of 291 million. And we then need to add back, step five, add back the interest expense. Well, again, we know we have a $1.5 billion deal, 30% of which is paid for in debt. So 450 million of debt times 8.5% is 38.3 million of interest. When we add that back to our 291.7, we get our combined EBIT of just under 330 million. We back out the 91.6 from the target, 200 from the acquirer, and we get our synergy number. So basically I just started at the bottom of this column and worked our way back up to give you an example. Now let's look at how things change when the purchase price allocation changes. So a $1.5 billion deal, same deal in column 2, but this one's paid for with more equity than debt. So as there's less equity than before, we're issuing fewer shares, but there's more debt, so we have a higher interest rate. This one actually shows, so our analysis shows that we can do this deal with about $1.5 million less of synergies and still come out with the same earnings per share. So it just goes to show that purchase price has an effect, but also the cost of financing has a big effect. Let's take it to an extreme example and go out to our third column, and we'll run through the numbers on this. Same purchase price. This one is financed 100% with debt, so we have no new shares issued. So still 100 million shares, and we know we need $1.30 per share. So we have 130 million of pre-deal and post-deal net income. If we divide by 1 minus our tax rate, 200 million of EBITDA, but now we need to add back a big interest number. We're paying interest on the entire purchase price, or 127 million of interest, giving us a combined EBIT of 328. When we back out our 291.6, we get 35.9. So it might say to this company, hey, if you could pay for this all in debt, it seems to be the most cost effective in terms of requiring the least amount of synergies. And let's take it to the other extreme. Same purchase price, no debt, all equity. So this company is simply going to issue new shares. So to pay for a $1.5 billion acquisition with shares that are worth $23, they need to issue 65 million new shares, add that to the original 100, multiply by the 1.3 of EPS. So we need a combined net income of just under 215 million. Divide that by 1 minus the tax rate, gets us EBITDA of 330 million. Again, there's no new interest here because we're not adding any debt. So 330 million less our 291.6 is 38.8. So you can see that funding scenario requires the most synergy compared to the others. So bankers would work with the acquirer here and say, let's find a cap structure that works for you. Let's think about the synergies. And it's kind of tough to precisely put a gauge on the synergies, but this company knows roughly, as we've looked at the two extremes, it needs about 36 to almost 39 million of synergies to make this acquisition of Makeup Co. worthwhile, or make it basically EPS neutral, no accretion, no dilution. And finally, let's look at the last column just to show, compare the final two. Here we've changed the purchase price. So suppose the acquirer gets in a bidding war, really wants Makeup Co., and it realizes it's going to have to pay more than 1.5 billion. It's going to have to pay 1.6 billion, and it still wants to fund it with all equity. So again, we've got no interest expense. We're issuing even more shares than we did before, and all of a sudden the synergies jump up to about 47.5 million. So that's the accretion dilution analysis, showing how purchase price, top row, form of consideration, next two rows, cost of financing, and synergies are the major factors here. Thank you.